Hello friends, I Dr. Praveen Narayan Mahamuni and I have chosen a topic which is very close to the heart of everyone, whether it is an individual or a big corporations. You can see in the screen that is financial management or finance. Why I have chosen this topic? Because finance is the foundation of every organization. That's why it is called as a blood of the organization. So in this video, we are going to cover the concept of business finance, meaning of financial management, and the objective of financial management. Let's see the concept of finance. So finance includes the capital, fund, money, and the amount. But each word is having the unique meaning. Studying and understanding the concept of finance become an important part of every business concern. Now, after understanding the concept of finance, we can understand the concept of business finance. First, we have to understand the what is meant by the business. A business means activity started for earning a profit. It's called a business. So, in simple word, any activity which have a motive to earn the profit, it is called as a business. So business finance, we can say that the funds and credit employed in a business, that we call as a business finance. Now let's see the definition given by the B.O. Wheeler. So B.O. Wheeler says business finance includes the business activities that are concerned with the acquisition and the conversion of capital funds in meeting the financial needs and the overall objective of the business enterprise. So we can divide this definition into three parts. First is a business activity, means activity which is run for or which have a motive to earn the profit. Second, concern with the acquisition and conversion of capital funds. So concern with the acquisition means collection of money for business need. So in meeting the financial need. So whatever the business need of the enterprises, for that purpose funds are collected. So in simple word, business finance means a provision of funds or money whenever required by the business. Now let's see the concept of financial management. So financial management is defined as a art and science of managing the money. Look, it is a art and science of what? Managing the money. Finance is a money, fund, capital, and management, it is an art of getting things done through this. So management means managing. So it is an art and science of managing money. It includes financial services and financial instruments. So let's see the worldwide accepted meaning of financial management. Financial management deals with the procurement of funds and the effective utilization of business. So in this meaning, two words are very, very important. That is the procurement of funds and the effective utilization of funds. Let's understand the meaning of these two words. First is procurement of funds. So procurement means a collection of funds. So how we can collect? So there are so many sources of collecting the funds. So we can collect funds from various sources like mentioned here, the equity share capital, preference share capital, debenture, term loan, etc. And these funds procured from various sources have a different characters or features in terms of risk, control, and the cost. So these three are the characters attached with the each source. The cost of fund should be a minimum. Hence, the proper balancing of risk and control factor become the essential. Thus, procurement of funds involves these following steps. First is a identification of source. So, which source we have to procure the fund. Second, determination of financial mix. So, from which source we have to collect. So whether a combination of equity preference or whether a combination of equity and term loan. So they can use the combination. So that we call financial mix. Third step is after deciding the determination financial mix, we can raise the money or raise the funds from that particular source. And last important, the division of profit between the dividend and the retention of profit for internal fund generation. So are procurements involves these steps, four steps, that is very important from the collection point of view. Now second is the effective utilization of funds. So as we know, funds are procured at a cost. So cost is attached with the funds. Hence, it is vital that to use them properly and profitably. And it is the responsibility of finance manager. So utilization of the fund is the responsibility of the financial. Also, procurement of funds is the responsibility of the financial man. So we can call the finance manager is the responsible not only for the procurement of funds but also the effective utilization of funds. He identifies the areas where funds become the ideal and why they are not used properly. He analyzes the financial implication of the each decision, whether to invest in a fixed asset, the need for adequate working capital, etc. So it is effective utilization is very important. So in the financial management, we seen it. The first is procurement of funds and effective utilization of funds. Let's see these factors which affects the procurement of funds. So there are three mainly important considerations, or we can call it the aspect related with the procurement of funds, which financial manager have to consider while taking a decision, that is risk, control, and the cost. Now in a table you can see there are two types of fund here. We can given the own funds and loan funds, and the cost, risk, cost, and the control. So in case of own funds, there is a low risk as compared to the loan fund, because in own fund there is no question of repayment of capital expect except when the company is under liquidation. Hence best from the point of view of risk. But whereas loan fund, whatever we have taken a loan, we have to repay as per the agreement. Interest should be paid respective of the performance of profit. If whether profit is earned or not, we have to pay the interest as well as we have to pay the EMI. Now, own funds are more expensive than the loan funds because loan funds are comparatively cheaper because prevailing the interest rates. So, the interest rates of the loan funds are much lower than the expectation of the shareholders from the company. So shareholders expect higher dividend than the interest rate. Now third is the control. In case of loan fund, there is no chance of dilution of control. But in case of own fund, there is a chance of dilution of control. Since it is a capital base, might be extended and new shareholders are involved. So for example, if there are the two partners, now they interested to expand their business and they decided to add one more partner. So now they become the three partner. Previous case, both are the taking the decisions. Now in this adding of new partner, the dilution of the decision making is divided into three parts. So it is diluted. So own funds, there is a dilution of control happens. Now next part, the objectives of financial management. Preliminary, there are two main objectives of financial management. As you know, first is a profit maximization. As you know, business is started for earning the profit. So profit maximization is the capability of the firm in the producing maximum output with the limited resources or use minimum resources or input for the producing stated output. So in simple word, they are looking for earning more and more profit by using minimum resources. So it has been traditionally recommended that the apparent of the motive of any business organization is to the earn the profit, and it is essential for the success, survival and growth of the company. Now profit is the long term objective, but it has a short term perspective, that is a one financial year. Profit is measured for a one financial year. So profit, how we can calculate? Total expenditure minus total revenue minus total expenditure. Though profit maximization, a firm can be able to ascertain the input output level which gives the highest amount of profit. Therefore, the finance manager of an organization should take his decision in the direction of maximization of profit. It is not the only objective of the company. Hence, the second objective is the wealth maximization. The objective of the firm should be maximize its share value or value of or wealth of the organization. Now the market value of the organization is based on many factors like reputation, that is we call as a goodwill, sales, service, quality of the product, etc. The wealth maximization is the ability of the company to increase the market value of its common stock over a period of time. So this value is the function of two factors, that is how the company is earning the or how the shareholders earning the per share, and the second is capitalization rate. So earning per share is depends upon the assessment as to how profitably a company is going to operate in the future, or what is likely to earn the each of its ordinary shares. Now second is capitalization rate. It is a cumulative result of assessment of the various stakeholders regarding the risk and other qualitative factors of the company. This rate reflects linking of investor for the company. So wealth maximization is the better objective for the business since it represents the both risk and the return. But profit is necessary for survival of the business. So these two are the preliminary objectives of the financial management. Let's see the basic difference between the profit maximization and the wealth maximization. So first is concept or meaning. So it is a process through which company is capable of increasing earning capacity that we call profit maximization. Whereas wealth maximization is the ability of the company in increasing value of its stock in the market. So objective period. So profit maximization having the short-term perspective, whereas wealth maximization having the long-term perspective or a long period. Risk and uncertainty. As we say in the wealth maximization consider the risk and the control. So it considers the risk and uncertainty, whereas profit maximization it ignores. Also, profit maximization avoids the time value of money because it is for the short period, whereas in wealth maximization they gives the importance to the time value of money. That's why they recognize it. Next is need. So in profit maximization or profit is necessary for survival and growth of the enterprise. Whereas wealth maximization accelerate the growth rate of the enterprise and aims at attaining the maximum market share of the economy. So in these points we can differentiate the profit and the wealth. So in short, profit is a necessary for the growth or for the survival and growth of the company, whereas wealth maximization is important for accelerating the growth generated by the profit and attaining the maximum market share of the economy. So thank you. I hope this video clears the concept of finance, business finance, financial management, and the objective of financial management. If you like this video, you can share and subscribe the channel. Thank you. Thank you very much.